Group scheme.
Welcome back. Federal Bank, as promised, the company has reported an excellent growth, both the return ratios, ROE as well as ROA. In fact, Abhishek tells us that the ROA is perhaps the best in 8 years, 32 quarters. Joining me now is Shyam Srinivasan, Managing Director and CEO of Federal Bank. Shyam, thank you very much indeed for joining me. But before I come to the return ratios, I know last time I quizzed you about that and you promised that your return ratios will only improve. 1.5 is extremely laudable. But the market on Friday only concentrated on your margins. Why were they 18 basis points lower? Almost every other bank has reported an improvement in margins except yours and Union Bank, who just spoke to us.
No, I think looking at just one quarter probably is inappropriate. But that said, that is the number which was in Q3. And if you recall, I had called out in Q4 results saying, while it is very nice to report those numbers, it's an exaggeratedly high number. And all of us know at some point in time, most banks are going to see some kind of contraction in margin. Ours is a touch earlier, maybe 1 quarter earlier. That also speaks to the profile of the book, right? Our deposits is largely and only retail. So if you have contracted long tenor deposits at a slightly higher, slower price, which may take 1 quarter later, it may sort of normalize. So I'm not sort of greatly agitated or perturbed by that number. It's almost the number we mentioned it would be. And I see that being the new base for us in FY24. So nothing that we are greatly disturbed by. That said, it's an area of focus for all of us.
Okay. Well, is this got something to do with how much of your book is linked to external bench, EBLR, and how much to MCLR? Is a large part of your book MCLR rather than EBL?
No. It's about 15% of the book is MCLR. So that gain you will see in the quarter ahead. I think it's just the profile of the book and in terms of timing of when our deposits mature, and maybe the race to get deposit growth. We saw 17% growth in deposits, almost 14% is retail deposit growth, Y on Y, and a large part of it is in Q4. So you did see people shifting maybe from savings to term, and it's only natural when the interest rates are high, people will go into the deposit branches. So in the quarter, our yield on assets moved about 36 basis points, and yield on when cost of deposits moved up about 55 basis points. So that difference speaks to the margin contraction. That said, I've mentioned, and I think we are reasonably sure that in the quarters ahead, our guided number 330, 335 would be the margin for the full year, which is, if you remember, last year exit was 320. We had said 10 basis point improvement. We came in at 331. This year, we think about 5 odd basis point improvement we will see. And that's what it'll be. I think the more important, probably the points that one has to note is the overall book shape, quality, credit quality is an all-time best. Credit cost for the quarter was 19 basis points. I don't know if any other bank can sort of speak to that kind of a number. So risk-adjusted margin, as has always been the focus of the bank, is in and around 3%, which is, I think, a healthy place to be in.
No, I take your point. Credit cost is a big positive, and I think that's the season. Many banks are reporting very good credit costs, and from the levels they are, dramatic improvements even in, look at a bank like ICICI Bank, huge improvement in credit costs. But, speaking about risk-adjusted, your actually risk-weighted assets have gone up. So that would seem like, you're taking more risk on the book. Are you comfortable with that? I think RWA is 90% now.
Yeah, I think we mentioned that when we had the call with the analysts on Friday. And that is only a point in time. About 4,000 odd crores of the credit book where the risk weights have gone up are, AA, AAA, A. But on the rating agencies have not linked that account. As you know, there's a new regulatory requirement that if an account is with a bank, it should also be rated in the rating agencies. Otherwise, you have to treat it as an unsecured credit for the unrated account. So you take a higher risk weight on that, but it doesn't inherently change the quality of the book in any fashion.
Okay, so that's the reason for the higher RWA.
Yeah. And you will see that moderating in the Q2, Q3 period when the rating agencies include them as also one of the lenders to the credit.
Okay. No, actually, if it doesn't result in higher slippages, it wouldn't be a worry at all. but slippages have inched up a bit, largely agri slippages. I remember State Bank used to tell us that their agri slippages normally go up in the first quarter. Is this a one-off, or should we be prepared for slippages here on as rates increase?
No, I think this is clearly a one-off. Only because if you see over many quarters, retail is about 130 to 150 crores slippage. The agri also includes gold and many other products. So at a point, in fact, large part of our agri book is gold, right? So even if slippages go up, we can auction it and collect the money. So we are not perturbed by that. It's in the region of about 130 to 140 crores this quarter. Normally, it's in the region of about 100 crores. So the slippage that is excess in terms of, say, let's say gold will come back in the quarter ahead. So those are actually positive for the period ahead.
All right. Can you just speak to us about the period ahead in terms of your lending book? Where do you see growth? Retail looks like everyone is in the same space, and that place has obviously become very competitive. Reserve Bank has actually written to you all, we understand, worrying about unsecured credit. So where do you see growth, and would unsecured be, and would you be bringing down unsecured credit?
See, thankfully for us, Lata, for not just now, for almost all our time, the book has been secured. We haven't forayed into unsecured in a very big way. So even as we start growing unsecured book, as a percentage of our overall assets, unsecured. One reason why our NIMs are relatively lower compared to many of our competitors is that we've been very cautious about the credit quality and the unsecured book. So for us, that's not a problem. In fact, I see that as an opportunity because as we get into unsecured, as we've done into cards and personal loans, when others are cooling off and we stick to our credit parameters, we see that as an opportunity for growth. I've always said that unsecured as a percentage of overall assets for the bank is going to be capped, not more than 8-10%. And we are at about 3-4%. So still a lot of headroom to grow.
Okay. So where is growth? Do you see it in retail? You've actually lent more even to your corporate book. Where do you see a capex cycle? What kind of advances growth are you looking at, and where?
Well, growth, as I've always mentioned, for us, there's an opportunity to grow 18-20%. Last year, we grew 20. Depending on the environment, we see similar opportunities. Even Q1 has begun quite well. We've been 55 retail, 45 wholesale kind of mix that we will stick to within retail. The mix of products that I just mentioned, cards, personal loans, home loans, commercial vehicles, all of them look like large opportunities. Our base is small, so we'll continue to grow. Corporate, in particular, FY23, corporate was very good. Saw good growth. I see that in FY24, a similar growth on the wholesale book, but tilted more toward the lower end of the corporate book, which is the commercial banking opportunity, where we see a sort of bigger growth opportunity. Being a bank which has a reasonably good credit quality and built a good franchise in terms of distribution for corporate, I don't see us going away from growth. Yes, if it tends to get too hot and pricing is too competitive, we may cool off in some areas, but I do see the current growth trend line holding for both corporate and retail. Opportunity remains quite broad-based as we sort of expanded across, increase our distribution. I see these growing quite smartly.
Well, 18 to 20% credit growth. Well, your capital adequacy at the moment is comfortable at 14.8. But you see yourself raising capital sometime soon, considering the growth that you're looking at?
Yeah, I did mention in the last call, as we did even the call with our analysts on Friday, we have a shareholder approval to go up to 4,000 crores of capital issuance. We are exploring this financial year, maybe this calendar year, but nothing as yet crystallized. But certainly we will be in the market looking at an opportunity in the course of financial year 24. The timing, it's early to call, but yes, there is an opportunity to raise money, all for growth, and thankfully credit quality and the overall return ratios being where it is. And you did point out both ROE and ROA, I would say lifetime high, very much on the promised lines. We said 15% ROE, full year ROE is 15. And one important thing which maybe missed your attention is all our JVs and subsidiaries for the first time have all delivered the same ROE or better for us. So the overall group ROA has grown up. And importantly, they contribute 5% to our overall profit. So I think the federal franchise is coming together a lot better. And which means capital raising should be more a compelling opportunity.
Okay, just a very quick question, both for you and for the industry, since you are, I think, now one of the senior most bankers. There is this big giant HDFC Bank out to gorge deposits because of the impending merger. Do you think that's going to, put a pressure on margins for everybody because you have to pay more for deposits?
See, we saw that in FY23, Lata. I know there were quarters when both SBI and HDFC were growing at about 80,000 crores of deposits in a quarter, right?
Yeah.
That is maybe like a 40% growth of the industry. That is, I think the benchmark is already set. All of us have factored that price impact and consequence onto our business models. So I don't believe that it will dramatically alter. But yes, I mean, you have to be a solid franchise to keep garnering deposits in this. Remember, they have a lot more to defend than all of us, right? They can't price out, and so I think it'll normalize. Yes, there will be a war for deposits, as it has been in the last 8, 10, 12 months. So I don't believe it will materially alter. It's probably at the peak at this point in time. So I believe FY24 will see more sensible deposit growth than it saw in FY23.
Okay, that's positive for not only you, but for the industry. Thank you very much, Shyam Srinivasan, for joining us. What the market took away on Friday, a part of it is getting restored now. The stock is up 1%, but of course, the entire market is up and about, bulls in full control. We wrap up on Bazaar on that note. Chartbusters up next.